Good morning. Welcome to today's tax planning webinar. Thank you all for coming. Most of you don't know me, I think most of you do, but if you don't, I'm Gemma Hedges. I'm a tax director at HWB. I'm also head of the tax advisory team, which is made up of myself, my colleague Alan Rolfe, who I'm sure many of you will know. Sway Alan. Anna does corporate tax and VAT, more specialist in those areas. And in our advisory team is also Jerry Robson and Stephen Martin, our lovely speakers today. What we're going to cover today, technology, is quite broad. You will be able to tell from the topic that it's a broad area. And pleased to hear that we're going to canter through those quite quickly. We're just going to focus on some of the tips within each of those rather than all of the detail within each section. And the reason we're so broad in our topics today is because there's actually 90 different taxes in the UK at the moment. And obviously subsections within those taxes. So I don't think anybody's missed the fact that the tax system in the UK is complex. And what the aim of this today is to see in those complexities what opportunities we have to make the most of some tax savings we can make. Have we thought about the reliefs available? Have we thought about the allowances available? What can we use to make those tax savings? And that's what the focus of today will be, what areas we can make those savings in. And why do we want to make those savings? Well, Rachel did very well last year. She made a grand total of just shy of £400 billion of tax in the last tax year. And when we look at that in reflection on previous years, we look at the percentage of the GDP, which is coming out as 38.5%. And that is actually the highest rate of percentage against GDP since records began in 1948. So for Rachel Goss, she's doing very well. For those of us that are facing a cost of living crisis and actually seeing a lot of that through additional tax that we're paying, we want to try and see if we can make some savings there for you, for your businesses. And that is absolutely the aim of what we're to do today. Now, I mentioned that there are a lot of different options. There's a lot of different areas we're going to discuss today. I would really encourage you not to think, I need to implement all of these. I need to make sure I've done all of these things, because you would literally be doing tax planning from the start of the year to the end. What I'd instead like to think about is, do I like that option? Does that sit nicely with me? Is it practical? Can I implement it easily? And if you can, run with it, implement that option. And maybe implement a few over the years. And little savings here and there will all add up, will all be very helpful to you. But don't feel like today you've got to do everything we suggest to you. It's just what fits best for you. Because tax, like individuals, is a very unique thing. And what works for one person won't necessarily work for another. So without further ado, I will pass on to Stephen. Sacks off.
Thank you. So I just wanted to start really by following on from Gemma, that one of the big issues that we're seeing is frozen thresholds, which equate to rising bills. So the personal allowance, for example, has been frozen since 2021-22. It's frozen effectively for a decade. So with inflation, the value that the personal allowance is worth has been eroded over time. It's the same for the higher rate threshold, and the additional rate threshold, which was £150,000, has been brought down to 125. And as a result of that, of over 4 million more taxpayers and be pulled into the higher rate by the end of 2029. So that doesn't help kind of whilst we have a cost of living crisis, the people in kind of the high rate in the basic rate threshold will be brought into the high rate band, feel the squeeze even more as a result of just no changes to allowances of thresholds. When we look at tax planning, really there's kind of three silos of tax planning. There's the quick, easy wins that you could do today, look at this month, and kind of make some savings. Then there's the kind of year-end tax planning that we'd definitely encourage you to kind of after Christmas start really thinking about year-end tax planning. And then there's the bigger, more strategic tax planning ideas. So this month, really, if you can look at bringing your self-assessment, getting your self-assessment done before the payment will calendar due, you can look, that will highlight where there's potential tax savings in the way your affairs are structured. Just simple things like reviewing a PAYE code, making sure you're paying the right tax now, because it's much easier to pay the correct tax now than it is to try and reclaim that back from HMRC. Using your ISA allowance early in the year always helps, so you're not the income isn't being generated in a taxable environment, it's being generated in a tax-free environment helps. And there was a lot of changes in the recent budgets around inheritance tax. So if you do keep a personal balance sheet, which I'd recommend everybody does, it's just worth looking at that, having a look at how the changes to the inheritance tax have affected you and what assets that were previously not in the scope of the inheritance tax have been brought in. In terms of year-end planning, looking at pension contributions, we're going to talk about pension contributions that all Joe is, so I don't want to steal his thunder, but looking at what allowances you've got available, what carry forward allowances you can use. Capital gains tax, usual annual exemption. So if you've got a portfolio of shares which is at that gain, you can embed an ISA, which is a strategy of realising capital gains up to the annual exemption. So you're not paying any tax. And then the proceeds of that move into an ISA. You can invest in the same funds that you held outside of the ISA. And so your investments, they change just moving from the taxable environment to a tax-free environment. Looking at if you've made gift aid donations. So they're often overlooked. So if you go to Marwell Zoo, for example, you'll get to sign a thing to say that you'd like to claim the charity. Really, people never claim that in reality, you see. So it's just worth kind of reflecting on, am I a member of the National Trust? Can I claim gift aid? All those small savings add up over time. You can elect to carry that back if you end up in a tax bind you don't want to be in. Looking at kind of what you're drawing from your company, can you get family members on payroll? Can you use their personal allowances and their basic rate bands to extract the value or the money from the company in a more tax efficient way? And then the more bigger ticket strategic tax plans may take a number of years to actually consider that. So looking at how you're drawing your pension, if your pension's exposed to inheritance tax, what can you do with that value? What are you going to do with your business? Have you got a succession plan? Do you know how you're going to pass that business on to the next generation? Have you got an exit plan? All of those are much bigger conceptual. You're not going to answer them in the afternoon, so it's worth looking at that. Looking at lifetime gifting for inheritance tax as well is kind of an ongoing strategy. And then the structure, the overall structure of business, is that correct? Do you want to change your shareholdings and give gifts, make some gifts of shares to family members so you can use everyone's dividend allowances? If you're selling the business or winding up, is a family investment company structure going to be suitable rather than just selling it and winding up? Jen is doing a webinar on family investment companies shortly, so I won't steal your thunder there. And just looking at kind of the bigger ticket items. The next thing I wanted to talk about is the 60% tax trap on income. So if your income exceeds £100,000, for every £2 of income over the £100,000, £1 of personal allowances withdraw, which gives a marginal rate of 60% tax on that band. So it's important that when you're looking at what funds you're extracting from your company, you're not going to put yourself into that 60% band. If you've got children, I was claiming tax-free childcare. If you've got 2 children, tax-free childcare, if you earn that extra pounds to take you over £995 to 100k, you're actually worse off until you earn 144,050. So there's some really horrific tax bands in there that it's just, you've got to be mindful of when drawing money out of your company. Just a quick example of that. So again, the salary goes up by the 25k and 25k bonus, for example. You lose your personal allowance. You pay an extra £15,000 in income tax. So you're only keeping 10k of your 25k bonus. What can you do to escape that trap? Pension contributions, salary sacrifice, gift aid to reduce your adjusted net income, which is the measure for that withdrawal of personal allowance. The pension contributions can be made by yourself, the employer. You salary exchange you can use, swap some salary for a tax efficient vehicle, or gift aid donations as well, just to bring the income down to restore that personal allowance. Effectively, you'll get a 60p saving on every pound that you contribute to your venture. Hand over to Joe, sounds a bit more about the ending.
Good morning, everyone, and thank you, Stephen. So I just want to now comment on the income tax impact of making personal pension contributions and gift. So Stephen's talked a lot about the tax trap, the different rates, and this is where we could show how much it actually saves you. Now, the relief applies, what I'm talking about here is for private pension or employee pension contributions which aren't done for a salary sacrifice scheme. And the reason I'm mentioning this is because quite often people overlook to claim this, or they've got private pensions and they're trying to claim with their IFA and they're not really aware of how it all interacts. But the main impact of making personal pension contributions or gift aid payments is that the individual's basic rate tax band will be extended, and the amount that it's extended by is the gross value of the personal pension contribution and the gift aid payment made. Just to add, salary sacrifice doesn't work this way. Salary sacrifice pension schemes reduce your assessable income, so they fall outside of this. So, for example, suppose we have an individual that made £8,000 of personal pension contributions for a year and £2,000 of gift aid payments. The net value of their total payments is £10,000, but this is grossed up to £12,500. This means that their basic rate tax band on which they pay tax at 20%, say on their salary, will increase from £37,700 to £50,200, which is an instant tax saving of £2,500 if they're a high rate taxpayer. But also, as well, the gross value of these two sets of payments reduces an individual's adjusted income for determining the clawback of child benefit, which begins to get clawed back when you earn over £60,000. And more crucially, if that personal allowance Stephen referred to is going to need to be taken away. Because if an individual had, because when you earn over 100,000, the personal allowance gets tapered away. But suppose we had an example where an individual had £110,000 of income. Oh, you think, oh no, they're going to lose their personal allowance. But if they made gross personal pension contributions in the same year and claimed for it on their tax return of £12,500, they all of a sudden do not lose any personal allowance. And just to mention as well, the gross and value of gift aid payments has the same impact. Now, to show the potential tax saved, let's go for a worked example. Now, this is an extreme example, I appreciate, but it just shows how planning for your pensions carefully can be very profitable. So suppose we have an individual with a salary of 125, 140, and no other income for simplicity purposes. Their income tax bill for 26-27 would be £42,516. In this instance, their personal allowance is fully gone. Now, suppose they make net personal pension and gift aid payments for the year that total £20,112. This would mean they've effectively made gross contributions of £25,140. Now, if that's all claimed from their tax return, the tax bill would be reduced by that 42,000 I mentioned to 32,460, which is a tax saving of just over £10,000. This means it's cost the individual just over £10,000 to increase their gross pension pot by £25,000. Now, this significant tax saving is made up of an additional £25,140 being taxed at 20% rather than 40%. And a big contributing factor is the fact that this individual's personal allowance has now been fully reinstated and they've avoided that dreaded 60% tax trap. So pensions, there are many things to consider, and I've only just touched on it, and what we're going to consider today, I only just touched on all the issues. But there are a few points I do wish to point out. When you're making your level of pension contributions in a tax year, you do need to monitor those pension contributions, because if you're making personal tax contributions and you do not have enough relevant earnings, tax relief will be capped at the level of your relevant earnings. and relevant earnings are salary or sole trader profits or partnership profits. Now, if you're a company owner, you may instead wish to make employer pension contributions. And as these are paid out pre-tax income, so you don't suffer a tax charge for it, and unlike private pension contributions, they are not capped at the level of relevant earnings yet. And it's more efficient than withdrawing money out if you're paying it direct from your company, rather than withdrawing money out, getting that income tax, and then paying the money into a pension scheme. And another significant advantage of making employer pension contributions or direct pension contributions to a company is that they're fully deductible for corporation tax purposes. So if £50,000 of employer pension contributions are made, that's £12,500 off your corporation tax bill if you're paying at 25%. But as I said, please do check the level of contributions you're making, whether that's employer, through employer, whether you're making privately, because there's this something called the annual allowance, and contributions that go above an annual allowance can attract a tax charge. Now, the annual allowance for each individual is currently 60 grand per annum, but when adjusted income, which includes employer pension payments, goes over 260, that begins to be reduced by £1 for every £2 your adjusted income exceeds 260, and it can be reduced to a minimum total of £10,000. So if you hit by that, you're thinking, oh gosh, I'll only make £10,000 of contributions in a year. But you can look for the previous 3 tax years to see if you've got any unused allowances in those years, because any unused allowances in those years can add to your annual allowance that are available to make for the current year. And that applies even if it brings your total for the year above 60,000. Now, if after all this, your allowances and the excess exceeds the annual, your contributions exceed the allowances, excess contributions, I'm afraid, would be charged at the margin rate of tax. But if you're in such a situation, you can make an election on your tax return so that the excess tax is paid by your pension scheme rather than you personally. So that's something to consider. I would also point out that in 2029, I think it was in the last budget, in 2029, HMRC are planning to cap the amount of salary that can be sacrificed from employee and employer pension contributions. Currently, this is unlimited, but from 2029, which is, I think, the date the next election scheduled anyway, so it could be scrapped. But from 2029, it is planned salary that can be sacrificed and be exempt from employers' NIC and employees' NIC will be capped at a meagre £2,000 per annum. So watch out for that 2029. It seems a long way away, but it'll be on us sooner than we think. So what other ways can we avoid that dreaded £100,000 tax trap? Now, this is maybe as so sizable as pension contributions and gift aid payments, but I think a lot of people forget that are tax-efficient investments, and they can lead to both income tax and capital gains tax advantages. The first thing I want to comment on is something that's quite well known. It's, remember, interest and dividend income received from your ISA is free from income tax. Now, I think most people are aware of this, and but for people who are straddling that dreaded 100 grand tax trap, it can present a significant tax opportunity, especially as they are high rate taxpayers. And given that we said that the effective rate of tax and income that falls between 100 and 125,000 is 60%. And because by having investment income earned for your ISA rather than, say, a normal bank account, your personal allowance is being preserved. Now, currently, everyone can invest up to £20,000 per annum into an ISA, and that's spread equally and that can be spread between stocks and shares, I assume, whatever way you wish. But please be aware, from the start of the next tax year, the amount that an individual can put into a cash ISA is capped at £12,000, but they can still put a remaining £8,000 into a stocks and shares ISA. I would add, if you are over 65 next tax year, you can still contribute £20,000 into a full cash into a full ISA. So one of the perks of being 65 or over, you can still use the full cash ISA sum. It's also worth remembering this whilst I'm talking about ISAs, that from April 27, the tax rates on interest income are planning to go up by 2% across each band. So rather than 20, 40, 45, interest will be taxed at 22, 42, 47% from April next year. And that, of course, increases the appeal of using an ISA. Finally, on ISAs, it's worth remembering that any disposals made in an ISA portfolio that attract a gain are not subject to capital gains tax. Putting investments into an ISA are subject to capital gains tax, deviating from a taxable wrapper to a tax-free wrapper. But remember, another perk as well as having the income free, the gains made on, say, stocks and shares ISAs when they're sold in an ISA, unlike other investments, will not be subject to capital gains tax. And if they grow in value, that's a particularly valuable saving. Now, I also want to comment on some probably lesser known reliefs that I do know a number of tax clients use that can provide a valuable source of tax relief. The first is enterprise investment schemes and seed enterprise investment schemes, or EIS and SEIS, as I'm going to mention now. These are aimed at startup businesses, and there's a whole host of conditions about what investments qualify, what investors qualify, but I'm not going to go into them there, otherwise I'll be here till midday. But to show you the appeal of these, investments that are made into qualifying EIS investment shares can attract income tax relief of 30%, and for the more deemed risky SEIS investments, the income tax relief available is 50%. So, for example, if an individual made £20,000 of qualifying EIS investments in a tax year and £10,000 of qualifying SEIS investments in that same tax year, their income tax bill would go down by £11,000, which is based on £6,000 relief in the EIS investment and £5,000 in the SEIS investment. If you don't have enough tax relief to knock off, because say the tax bill for the year was £40,000 and the relief wouldn't go against your taxable income, it reduces your fine on taxable income. So a tax bill of say £40,000 would be reduced to £29,000 as a result of this. Now, sometimes people can make huge investments in a year, they don't have enough tax to cover the relief that's available, and the tax relief upon these investments can be carried back to an earlier tax year. And that's something you wish to do, especially if you haven't got enough tax liability in the year that investment to absorb the reliefs available. A crucial thing on these, from a tax advantage on these investments, is that if these investments are sold later on, no capital gains tax will be due on the investment. So long as you claim income tax relief on the investment on your tax return first hand. And so some people think, oh, it's only a 50 quid breast, and what's the point of claiming EIS income tax relief and getting the paperwork and going through all that? But if that EIS investment turns out to be the next big thing, I mean, yeah, you could save yourself potentially a lot of capital gains tax just by doing that extra bit in the long term, just by doing that big little bit of paperwork. There is another perk with these investments as well, is that if you make other chargeable gains in a year, a taxpayer can reinvest the gain made in EIS shares against those gains made up to 1 year before or 3 years after the original asset was sold. But this acts as deferral. The gain doesn't disappear, but it's deferred until when the EIS shares are sold later on. So, for example, suppose an individual makes a chargeable gain, say, on taxable investments for £100,000 and reinvests £50,000 into qualifying EIS shares within the qualifying time limit. Then £50,000 of the gain is subject to tax now, but the other 50% is deferred until the EIS shares are later sold, which could be a very useful cash flow advantage. So do consider that. By contrast, reinvestment into EIS shares don't defer the gain, but instead the gain is reduced by 50% of the reinvested total. So in the example I gave, suppose they're SEIS shares instead of EIS shares, 50% of the 50 grand reinvested will be exempt from capital gains tax, and while the other 75 grand of the gain is taxed. Now, I've only just done a whistle-stop tour of these reliefs and how they work and They are very complex, and you probably need to seek investment advice if you ever were considering these investments. And there are a lot of rules to consider. There are a lot of tax traps, and plan if you are considering using these investments, because we don't want you to fall foul of a tax rule that can trigger a tax charge. Finally, on this subject, I just want to briefly mention qualifying venture capital trusts, or VCTs. They can get income tax relief of 20% subject to an annual investment limit of £200,000, which gives a tax saving of £40,000. But crucially as well, the dividends from qualifying VCT investments will always be free of income tax. Now, the relief on these was 30% in the prior tax year, but it's dropped down to 20%, but you still get that useful tax relief, but you also appreciate as well, do not pay income tax on the dividends. And now I'm going to hand back to Stephen. Joe?
So in the last budget in November 25, the Chancellor increased headline rates of dividend tax by 2%, 2% big deal. But what it has done is flip, potentially for a lot of people, how you should extract the profits from your business. So historically, you couldn't really go wrong if you took a minimal salary, pumped the rest out in dividends. You know pretty much you did need to run the numbers there or thereabouts. That's the most effective way to draw from your company. That extra 2% on the dividends has changed that. So you can see the old headline rates and then the actual rate of overall tax of drawing that cash out of your business. So that would eschew for the 25% corporation tax. So for higher rate taxpayer, it used to be just over 50% of your business income or profit that would get absorbed in tax in you drawing that out as a dividend. That's now increased, and it's flipped. What's more efficient to draw money out of your business now? So salaries, if you're an additional reg taxpayer, the overall marginal rate of tax on your salary is now lower than the overall marginal rate of tax on the dividend. The margins between the two has massively closed in recent years, but it's something that I think every business owner needs to look at. Is my strategy for extracting money from my business still efficient? So as business owners, you need to look at how you're remunerating yourself and your staff. So salary or dividends is the main thing, because that has changed this current tax year. And there is no one size fits all. This is definitely the right answer. That's definitely the right answer, because it depends on the margin rate of corporation tax your business is paying. If you're potentially paying, claiming R&D tax reliefs on your salary, that changes the factor. There's no one size fits all, sadly. So it's something that I would encourage everyone to actively look at. Ultimately, I think everyone should consider as well, what do I actually need? Do I need to be drawing such a big salary every year, or extracting so much cash from the company? With those marginal rates of over 50% of tax overall, do you really need to be drawing such a large income? Can you reduce it? It's something that definitely needs to be considered kind of prior to the tax year end. Also, if you've got other sources of income, for example, property income, the way you draw income from your business can affect how the tax on your rental property is taxed. If you've got a mortgage on it, it might affect your ability to claim mortgage tax relief on that. So we need to be looking at everything in the round, just not the business as a whole. It's kind of you in detail. Again, as Joe said, you can use pension contributions to extract that value free from tax from the company. There's a lot more to consider now with that extra 2% of dividend tax. You also should be considering what tax efficient benefits you're claiming. So it could be an efficient car, electric car that typically tax efficient way of extracting funds. And then there's a number of small wins in there as well. If you're into cycling, can you use the cycle to work scheme to get tax relief on your bike? low emissions cars have said. Pension contributions, again, keep coming back to pension contributions as an effective, tax efficient way of drawing money out of your business. And then there's the really trivial benefits, like a voucher of £50, but that's not related necessarily to your job. So you can get a £50 voucher as a director 6 times a year. It's £300 tax free out of your business. So there's all those little wins we need to be looking at as well. Is your company paying for your professional subscriptions, medical checkups? Is your company providing you with your mobile phone, or if you got that mobile phone personally, a mobile phone's a tax-free benefit. So the expense of running the phone, the contract of your phone, should all be claimed corporation tax relief by the business, rather than you paying out of your tax net income. So I want to move on to capital gains tax. There's been a number of tweaks with capital gains tax in recent years, but tax planning still pays is the main message I want to get across here. So the annual exemption is now only £3,000. So it's important that we're looking at kind of, before you realise or crystallise capital gain, can we do an inter-spouse transfer to get 2 allowances to get £6,000 free from tax? You should be doing kind of better, nicer if you've got a portfolio of shares and then should look forward, sell your shares, realise 3,000, crystallise 3,000 fund gains tax free, move those shares into an unsold purchase, and in the eyes that you've still got the investment, but it's just a tax free environment. And timing disposals, I think now is more important than ever. If, say, for example, you've got a portfolio of properties, some are sat at a gain, some sat at a loss, you would look to sell the property at a loss first to crystallise that loss, and then sell property at a gain at a later date, because you can't carry back capital losses into other tax years. So just looking at what you're selling on when, and just, I think the message is to think about what you're doing for capital gains tax. Business asset disposal relief is nowhere near as valuable as it was. It's worth £60,000 tax saving now. But again, spousal transfer, if you're considering selling your business, we need time to move the interest in your business to your spouse in order for them to claim that relief. So that's, again, kind of the longer term thinking about what your overall tax cushion strategy is going to be. Some reliefs that haven't changed are holdover and rollover reliefs. So that gives you the ability to defer capital gains tax if you were to hold over a gain, or if you sell it, if you own a commercial property, for example, that's used by your business, if you sell that, you purchase another one, there's time limits around deferring the gain of the first property into the purchase of the second property. So you just need to be thinking about kind of what reliefs are still available, using those reliefs that can provide useful cash flow advantages. There's been so many changes to inheritance tax over the last couple of years. Business property relief and agricultural property relief are kind of the headline ones. That's why you see can't be around central London without seeing a tractor. So it used to be completely uncapped 100% relief on like business assets. It's now been 2.5 million on the first, 100% relief on the first, and 50% relief thereafter. So if you have a business and you think the value of that is more than 2.5 million, we need to be looking at, right, your inheritance tax exposure on that business has now changed. Can we split the ownership between other family members? What can we do to secure kind of that passing on that legacy to the next generation free from tax? AIM shares have been changed, so that's shares listed on the alternative investment market. If you invested in shares on AIM, if you held them for 2 years, they used to be 100% inheritance tax relief on those. The Chancellor closed that off, so it's now only 50% inheritance tax relief. So there's still a benefit there to being invested in AIM, but it's just not as tax efficient as it used to be. And I think the biggest change that we see for April 27, which I don't think it's really got enough press coverage is that unused pension funds held at death from April 27 are going to be included in the calculation of inheritance tax. So the strategy always was, don't touch your pension, don't touch your pension, you can pass it on free from tax. From April 27, that changes. So you need to be looking now at kind of who your nominated beneficiaries are for the pension to ensure that you're qualifying for the spousal transfer. Because before, you might choose to leave your pension to not your spouse because it's free from inheritance tax. Now it's important to the kind of spousal transfer, making sure you claim that, and the potential exposure on not doing something with your pension by the time you pass away is the tax rates could be in excess of 67%. So £100,000 unused pension pot, your descendants will only receive potentially 32,000, maybe less. So that's something that really needs to be looked at and considered.
Right back to Joe. Thank you. So now we're going on to more issues that maybe affect corporation tax or sole traders or partnerships. And the first thing I want to talk about that comes our way a lot and is in the accountancy world that people do need to consider, probably don't pay the due attention to, is before purchasing a commercial building, whether in a personal capacity or through your limited company, pause, speak to us and consider how is this going to be purchased, because if it's structured correctly, it can lead to a long-term tax bill. The first thing is to mention that if it's right for you, a commercial building can be purchased through a pension scheme rather than being purchased through a company or individually. The benefit of this is that the income received into the pension scheme will not be subject to tax, as this is not you, but the pension scheme that owns the property, and pension schemes are not subject to tax. If the property in this case is being let to a connected party, such as your own personal company, you need to demonstrate that in this case that the rent is being charged on an arm's length basis. And in these cases, the rental income is put direct into the pension scheme, and the scheme can potentially then fund future property improvements. Now, that's only a brief introduction on this topic, and careful financial advice will need to be sought, and we'd recommend you speak to us and whatever financial contacts you've got before pursuing this option. But just be aware that this does exist. Another major factor is if you are considering a commercial building and you're going to purchase it for yourself or for your company, is can I make an S1 non-net mention? What is that? And your solicitor should be bringing it up. And if you come to us, it's something we would mention, because an S198 election is in connection with capital allowances, which is capital expenditure that falls outside the P&L at profit and loss account, but can be reduced against your overall taxable profits. And an S198 election is a joint election that is signed by the vendor and the purchaser, which allocates the value of the building's cost to qualifying fixtures and fittings. And why does this matter? Because the reason you as a buyer want to use is because fixtures and fittings can potentially qualify for capital allowances, and which can lead to a significant tax saving of up to 100% the value of the fixtures and fittings in the period of purchase. And so the simplest way to demonstrate this is through a worked example. Suppose we got a company that purchased a commercial building to trade in. It will on face value get no capital allowances to go against its taxable profits, as capital allowances aren't usually available on buildings. But if after much identification and agreement with the vendor, they agree that £200,000, say, represents the value of fixtures and fittings in that building, a deduction of £200,000 can be made against the taxable profits, which can represent a corporation tax saving of £50,000 for a company, or if it's an individual paying the additional rates, £90,000. Now, this election, the NEAT would really recommend we do it at the outset before the deal is completed, because it needs to be agreed by both parties. And you may find that the vendor is reluctant to pursue this, as it can increase their tax bill because they're creating something called a balancing charge, which I won't go into. So we would recommend, if this is discussed with your solicitor beforehand, as in practice, it can be very difficult to agree retrospective valuations with the vendor. On this topic of commercial buildings as well, what is not so well known is structural buildings allowance, which gives tax relief of 3% per annum on the cost of the construction new buildings that take place from October 18 onwards. But this 3% reduction allowance only applies to commercial or trade buildings. It does not apply to residential buildings. So, how would this work? If a company bought a newly constructed qualifying building for £1 million, it can get tax relief of £30,000 in year one, which reduces the tax bill by £7,500. May not seem relative large amounts, but over a scope of 10 years, just by claiming this relief, you save £75,000 corporation tax. Now, this allowance doesn't necessarily lead to a long-term tax saving because the allowances claimed will be added to the proceeds total when calculating again on any later disposal of the building. So no long-term saving, but it does give a very useful cash flow advantage for the business purchasing the building. And it's worth also noting that the relief is also available for, say, renovations or extensions to your building that have taken place after October 18. So if you're purchasing a building and you know it's constructed after October 18, ask about this allowance. Now, sometimes you might be in an instance where you've purchased this building and someone else has previously claimed the allowance. So you can inherit the allowances that they're available to claim if you ask for a statement showing the allowance is stoked, because I think it's spread over 33 years to it's fully wound out. And if someone's owed it, claim 10 years worth of relief, you can still claim for the remaining 23 years, but you need to get that allowance statement off the vendor. So it's just bearing in mind when you're purchasing commercial buildings, a few things to consider. Stop, speak to us, and we can outline the potential tax savings that are available to you if they are appropriate. Now, something that lots of people ask me about and comes up quite a lot is electric cars. What benefits do they bring? Because if you are a business owner looking to purchase a company car, you may wish to go electric rather than a normal car because the benefits in kind of non-electric cars are just ridiculously high. The main reason a business finds the benefit of purchasing an electric car, the main big benefit business gets, is that a new electric car, and I emphasize the word brand new, not second hand, can qualify for 100% first year allowance in the year of purchase. But at the moment, this relief is only up until March 27. I would imagine, well, I can't imagine, but in previous budgets, this time limit of when the relief runs out has always been pushed on a year. Like last year, it was due to expire in March 26, but last year's budgets extended it by another year. So whilst people, I think, are so used to it now, they even think it lasts indefinitely, the current rules is only in place up until March 27 for 100% tax relief. Now, as I said, you get 100% relief against your taxable profits in the year of purchase. And the other benefit as well is the income tax charge for the private use of the car is much lower. Now, if the electric car purchase is made available for private use, which includes ordinary commuting, the benefit in kind is based on 4% of the list price in the current tax year. But be aware, once this is relatively small, be aware this is increasing by 1% next year and 2% for the following 2 years. So by 29-30, the benefit in kind charge on an electric car is 9% of the list price, which is more than double what it is at the moment. So just be aware, whilst they are still more beneficial than normal cars, it is increasing. The best way to demonstrate this is through an example. So suppose we have a company director and they're looking to buy one of 2 brand new cars, and they've both got a list price of £70,000, which is also the list price. One is pure electric and brand new, and the other, say, has a CO2 rate of 75 grams per kilometre. For capital allowance purposes, which goes against their taxable profits, the electric car will get full relief in the year of purchase, but the other car doesn't. Instead, it will go into a capital allowance special rate pool where the relief is only given at 6% per annum. So the contrast in corporation tax is in year one, the company who buys the electric car will save over £18,500 in corporation tax compared to relief of £1,125 on a non-electric car. But do remember, the electric car doesn't get relief in later years, whereas the non-electric car will continue to gradually get the small allowances each year. Where it also is in terms of calculating the benefit in kind. For the electric car, it would be £2,800 per annum in your current tax year, but for the non-electric car, it will be £14,700 because in this instance of the 75 grand kilometre rate, the benefits charged are 21% of the list price, which is substantially higher. So therefore, imagine if the benefit in kind value fell within a director's high rate tax band. If they go for the electric route, they will save £4,760 of income tax. In addition, the company will save Class 1A national insurance of £1,191 a year by going down the electric route. It's example. So yes, electric cars are increased. The benefit will increase over time, but at the moment they are currently far more beneficial from a tax perspective compared to normal cars. Right, the next topic we'll talk about is associated companies, and because there are some planning tips around here. Now, for corporation tax and associated companies, where we have a situation where one company controls another company, i.e. owns over 50% of the ordinary share capital, or if both companies are under common control, whether that be through a common individual or a common holding company. So let's suppose we have an active trading company that owns 51% of the shares in another active company. Those companies would be deemed to be associated with each other. Or if we have 5 companies that are all controlled by the same holding company, each of those 5 companies would be deemed to be associated with each other. Another example is, suppose we've got an individual that personally holds 51% or more of the shares in 2 separate companies. Although they're not linked together by companies, they are still deemed to be associated for corporation tax purposes. Now, these are just simple examples, and the rules can get far more complex. You say, why does this matter? And the above matters because the number of associated companies determines the rate of corporation tax due that a company may pay. Because currently, if the company's profits are under 50,000, it pays 19%. If profits between 50 and 250 are paid at the margin rate, and profits over 250 are paid at 25%. Now, suppose the company had profits of £49,000, you would think the tax is due at the 19% rate. But if that company had 6 other associated companies, the £250,000 limit is divided by 7, and the higher threshold is just over 35,000, meaning the company should now pay tax at the 25% rate. But where this matters more is determining whether a company should pay its tax in instalments or not. Because if profits are over 1.5 million, a company is required to pay its tax in quarterly instalments, and the first installment being 6 months and 14 days from the start of the accounting period, rather than the usual 9 months after the end of the accounting period. And the quarterly instalment threshold is divided by the number of associated companies. So imagine we've got a company who has profits of £800,000. They would normally need to pay their tax in instalments, and it just pay it 9 months and 1 day after the year ends. But if it has one associated company that's active, the instalment threshold drops from 1.5 million to 750,000. And all of a sudden, that company is now paying corporation tax in quarterly instalments rather than 9 months after the year end, which can be a serious cash flow disadvantage. Therefore, if you are paying corporation tax in instalments due to your associated companies, or you're on the cusp of doing it, our tip would be you may wish to consider if those other associated companies are necessary, especially if their activity is minimal. Can you close them down? Can you move it into the other company? That's a tip that you may wish to consider, because even if you have one associated company, say it only has like £5,000 of outside investments in your it will have the effect of of being an associated company, and it will come into play in the examples are shown below, shown here. Now, I also want to mention an associated company does not include dormant companies. So if you've got a company that's, say, a holding company that's just receiving dividends and paying them out, that's not an associated company. Where people miss the rules are that an active overseas company, even though it's not registered for UK tax, is still an active company for associated companies. Other thing I want to mention on a planning point of view is that if companies are part of the same 75% group, i.e. they have rather than 50%, tax planning opportunities present themselves in the form of group relief, which would allow a loss-making company to offset its losses against profits made by another company that's in the same 75% group. So, for example, if Company A owns all the shares of Company B, and Company A has made a trading loss of £200,000 for the year, and Company B has made a trading profit of £500,000 in that same year, Company A can surrender that loss against Company B's profits, which can save £50,000 of corporation tax. It would mean that Company A would not be able to carry the losses forward, but by making a group relief claim rather than carrying the losses forward, the group of businesses has got a major cash flow advantage. Now, this is a very basic introduction to this area, and the relief can extend forward to unrelieved or forward trading losses when they occurred on or after April 17. And there's many other permutations that would need to be considered. But the key takeaway is to be aware is that unlike being an associated company, common corporate ownership must be 75%, not 51% for the relief to apply. I would point out that as well that we've seen people misunderstand or speak. What about if they're controlled by the same individuals? So say if I owned Company A 100% in my own name and Company B 100% in my own name, I would not be able to claim group relief from one company to the other, because for group relief to be available, the companies had to be in a corporate wrapper. It can't be controlled by an individual. Connection cannot be through an individual. It must be through another company. So that's some things to consider there. Finally, from me, very topical at the moment, making tax digital, which feels everyone would dread, or have heard it called making tax difficult. How all this works is that for sole traders and landlords within a making tax digital regime, they have to file everything quarterly, and the first quarterly return is due 7th of August 26. But I understand there was a soft landing, and quarterly installments will be due quarterly returns will be due every quarter after that. Now the TAP isn't paid for this, but it creates a lot more filing and admin and burden, because this is going to fall on top of the self-assessment tax return. It doesn't reveal it. It's in addition to the sort of more self-assessment tax return. So who has to do making tax digital? So for the current year we're in, 26-27, making tax digital is mandatory for all sole traders and landlords that have turnover in excess of £50,000 for 24-25 tax year. So the revenue will see if you should have joined the scheme, because they will look at the 24-25 tax return, and if your turnover from rental income and sole trade activities is over £50,000, they will expect you to enter making tax digital. From April 27, landlords, sole traders with turnover in excess of £30,000 in their 25-26 tax year will be mandated to join this scheme from April 27. And for the year after that, it's expected that those with turnover just over 20,000 will be mandated to join the scheme. So it's going to capture more people than it isn't. Now, as I've indicated, the turnover totals are based on the latest tax return, and it's based on a combined total of sole trade and rental income. So if you have 49,000, you get sole trading turnover, and 49,000 of rental turnover, you've not escaped making tax digital. So it is vital that records are kept so that you're prepared for these changes, because it's the admin burden is going to increase significantly. Now, one thing landlords may wish to do to avoid making tax digital is, could they say split the income with the spouse, because the way you're introduced for making tax digital is looked at the individual rather than the collective unit. So if you have Mr. Smith, say, owns properties in his own name, he gets 40,000 turnover, 60,000 turnover, he's required to join making tax digital this year. But if those properties are jointly held with his wife, they both got £30,000 of turnover and they're not required to join making tax digital. So you may, but with in line with all the thresholds that are being introduced, some taxpayers may wish to consider transferring properties over or splitting ownership or to avoid the online filing requirement. But before doing this, please ensure you do get tax advice, because whilst you don't want to unwittingly trigger a tax charge by making a transfer. Because, for example, whilst transferring a property to a spouse is free at capital gains tax, if there's a mortgage on that property, you will walk into a stamp duty land tax trap. So if you are considering avoiding MTD, as in the example I described above, it can be done, but do make sure you get tax advice first so that you don't unwittingly create a tax charge to avoid an admin burden. So yeah, that's all for me for now. I'm going to hand back to Gemma.
Joe, thanks, Stephen. Yeah, so some really great tips there. Like I said at the start, you do have to do all of them. Even if you just start with, let's make use of my ISA, have I thought about putting a bit more into my pension? And then when you go car shopping, you go for the electric car rather than the other car. Even if you just do that, you're still making savings. So it's just working out what we talked about today, which is the right fit for you, is simple for you, rather than, you always say the tax tail shouldn't wag the dog, something along those lines. But ultimately, the aim of it is to make the most use of the allowances and exemptions, the reliefs that are available to us, because there are plenty. It's a complex environment, but there are those opportunities there for us. And also to plan rather than react. We have had, particularly with this government, a lot of scaremongering in the press. We should do this, what about if she does this? And what has happened in previous years, or before the November budget, was that people listened to the press. They listened to what those scaremongerings were. They reacted to them and made decisions that meant they actually make a tax decision worse. So what we would try and encourage you to do is not react, not panic, but plan carefully with the rules that are correct and in place to make sure you don't also fall into that trap. And that is always easier said than done, because some of the rules are not coming out in a budget like it used to do historically. Some of them she's just bringing in as she's going along. So we had the change to business property relief, came out on the 23rd of December, just before Christmas. It was broadcast as isn't it a nice present to the farmers and to the landowners? But actually what that meant for advisors is we had to all tell our clients very quickly in the Christmas break that there was a change to the tax rules. And that can be quite difficult to administer. Just recently, she's changed the mileage allowance. She's increased it by 10p, so it's now 55p in the main rate. That wasn't in the budget. It's just spur of the moment. She's also done some VAT relief for people taking their kids out on summer holidays. And again, these are not in budgets. These are just things she's standing up and saying. We're not getting any advantageous notice of these rules. They're just coming in a wee here and then when you do. So I really encourage you, if you're not already, to sign up to our bulletins and our e-news. The bulletin comes up quarterly, the e-news monthly, and this is our forum where we say, this is what's changed. This is the new rules that she's brought in, so we can keep you all up to date with the rules that are actually in place. So not what the press think might come in, what has actually come in. And the articles always have a contact at bottom that you can speak to if you think, actually, that's relevant to me. I'd like to make those savings. I'd like to take advantage of that opportunity. So please do sign up for those if you haven't already. It is the people that have spoken today. And as I said, we've also got Alan with us as well. If you do have any questions and actually don't want to raise it today, please do email us. We're always happy to answer any of those questions for you, or you can answer them in this room, or come and see any of us at the end of today. We'll be out by the coffee if you've got those questions you prefer not to speak back in the room.